Hello and welcome to the lecture for part 1 of chapter 6. So chapter 6 deals with long-term operational assets. So things like computers and buildings and machinery and trucks and all of the things that you need to run your business. So in this part, I'll talk about how to determine the cost of those items, because sometimes it's more than just one amount. It's a combination of expenditures. And then I'll talk about different ways of depreciating that asset, which is a way of spreading its cost over its useful life. So I'll talk about straight line, which is the most popular, double declining balance, and units of production. That's what I'll cover in the first part of this lecture. The second part of the lecture for chapter 6, I'll talk about gains and losses on disposal. So what happens when we sell those kinds of assets? I'll talk about revising estimates, about continuing asset-related expenditures like maintenance and improvements. How do we account for that? I'll talk about natural resource accounting. So maybe we own stands of timber or a coal mine. How do we deal with that? And then I'll finish up by talking about both the cost and the amortization of intangible assets, so assets that we can't touch or see. So I want to start with an overview of assets. So again, remember, assets are things that we own in our business, okay? And that's going to consist of current assets, which is what we've been talking about up until now. So things like cash, accounts receivable, inventory, prepaid items like supplies and prepaid insurance and those kinds of things, prepaid rent. Those are all current assets, meaning that we expect them to either get used up or turn into cash within the upcoming 12-month window of time. All other assets, by definition, are long-term operational assets, so things that last more than a year. I'll divide long-term operational assets into two categories. One would be tangible assets. Tangible assets, of course, are things that you can touch and see. You'd go into the business and identify those by looking at them. That would include property, plant, and equipment. Plant is another word for factory. So it would be buildings and then all of the things in the building like computers and forklifts and trucks and those kinds of things. It would include natural resources. So some companies own natural resources as part of their business. And then it would include land. And we separate land out because land is the one asset that we don't depreciate because it never wears out. So we always separate land out like that. The other category is intangible assets. Those are assets that provide value to the business. It's something the business owns, but it isn't something we can touch or see. And an example would be a patent or a trademark or something like that. So those fall into two different categories, either intangible assets that have a fixed, identifiable, useful life that we can use to spread the cost over that period of time, or there's some intangible assets that potentially could last forever. So they have an indefinite useful life. So the cost of a fixed asset is going to be all of the cost required to get that asset to your business and functioning as you need it to in your business. So of course it's going to be the purchase price of the machine as an example. It might also include freight charges to get it from wherever it's located to your business. You'll probably have to pay sales tax on it. So you might have to make repairs to it in order to use it for your business. In the case of used equipment, you might have to do that. And you might have to make modifications to it for it to work in your particular company. And then finally, there's testing often. And that testing may require some employee labor time. That would be included in the cost of the asset. It might include some materials that you go through in the process of testing the asset, so that would also be included. So it would be all of those costs, and that's very common. In businesses that I've owned, I've bought machinery that included all of those items: inbound freight, sales taxes, repairs, modifications, and testing. So it could easily double the cost of a fixed asset beyond the purchase price. So a kind of a concrete example of that would be, say you want to be an independent contractor and be a delivery agent for Amazon. So Amazon would require you to buy a Sprinter van like you see here. And then you would probably have to make some changes to it. You would need a particular paint job. You'd need the Amazon Prime logo on the side. That would cost money. Inside the van, you would need it outfitted with shelves and netting and different things to keep boxes from flying around, so you'd need those costs as well. And then you might need some electronics added to the van for maybe GPS tracking or things like that. So those are all additional costs that you would need above and beyond the purchase price of that Sprinter van, and all of those costs would be included in the cost of that asset in your delivery business. So next, let's talk about depreciation. So depreciation is the operating expense associated with owning fixed assets. And again, fixed assets are going to lose value over time, either through physically wearing out or functionally wearing out. So say as an example, you have a group of salespeople in the field and they all have flip phones that are 15 years old. Well, those flip phones still might work. They might make phone calls, but they're functionally not really useful any longer because they don't have a GPS on them or email on them or other things that a smartphone would have. So they haven't really worn out, but functionally they've worn out in effect. So the purpose of depreciation is to spread the cost of that asset over its useful life, right? To take some of the expense in each period. Imagine if you bought that Sprinter van we just talked about and say it cost you $50,000 and you believe that's going to last you 5 years. Well, if you expensed it in year 1 completely, it would make year 1 look bad and make years 2 through 5 look great. By the same token, if you wait until the van dies and you push it into a ditch at the end of 5 years, it would make the 5th year look bad and all the other years look good. So we want to try to match the expense of wearing that van out with the revenue that we earn from it. So it's a method of allocation, not of determining market value. So depreciation expense is going to be based on a couple of different estimates. Well, one hard figure and then some estimates. So the hard figure is that initial cost of the asset, which I just talked about. The other factor is going to be the useful life. So we'll make an estimate of how long we intend to use that asset in our business. That might be less than how long it might last in the world, but how long it's going to last in our business is what we want to use for its useful life. And then last is salvage value. Some people call it scrap value. So what is it worth at the end of its life? It might be worth, just about everything is worth something at the end of its life. So we'll determine the depreciable cost, how much we're going to spread by taking the initial cost and subtracting the residual value. So we'll take that depreciable cost and we'll spread that over the useful life. And there's a couple of different methods for doing that. One way to think about it is the life cycle of an asset. So the first step is to acquire funding. So maybe you put money into your business to buy that Sprinter van, or maybe you borrow money from a bank to buy that Sprinter van. So the first thing to do is acquire the funding that you need. The second step is to acquire the asset. The next step is to use the asset, and that may be over years. While you're using that asset, that's where you're going to depreciate it. So again, if you buy an asset and you're not using it, then you don't start depreciating it until you start using it. So that pie chart there shows what kind of methods people use for depreciation, and I'll talk about all three of those. As you can see, straight line is far and away the most common. It's also the easiest from a math standpoint. Then the last step, after you're done using the asset, we would retire it, and we'll talk about that later as well. So the most common method, again, is the straight line method of depreciation, and that's what it sounds like. It takes a linear approach to it. So in this case, let's say we have a $24,000 van with a $4,000 salvage value, and we believe it has I have a typo there. It should say a 4-year useful life. So I take the cost minus the salvage value, that's $20,000, and I divide that by 4 years. That means I would take $5,000 in depreciation each year. The way that would look on a set of financial statements is you can see on the income statement each year I would have $5,000 of depreciation expense. Again, that matches that expense of wearing that asset out with the revenue I'm recognizing. And then on my balance sheet, notice under assets, I have van at 24,000. I don't change that. I leave that at that value. And the accumulated depreciation is one of those contra accounts. So it has a negative balance and it offsets the value in the van. And that increases each year as I depreciate it. Notice it goes from 5 to 10 to 15 to 20. So when I reach the end of the 4-year period, notice that the carrying value or book value of this van is $4,000, which equals the salvage value. So we're depreciating it to the point where the book value approaches and finally equals the residual or salvage value. The next method is the double declining balance method, and it's used when we have an asset where we want to recognize greater depreciation in the beginning and less depreciation near the end. Let's say you make a machine that can create a case for an iPhone 12. And it's going to last for 5 years. So you're probably going to sell a lot of iPhone 12 cases in the beginning. And at the end of 5 years, when they're up to the iPhone 18 or something, you're probably not selling very many cases for the 12 any longer. So you might want to depreciate that more in the beginning and less near the end because of the benefit that you're getting from it. So this is a very common method for that accelerated method of depreciation. So the first thing we'll do is determine the straight line percentage based on the life of the asset. So say as an example, we have a 4-year asset. That's going to be 25% each year. So the straight line percentage is basically the fraction of 1 over 4. If it was a 10-year asset, the straight line percentage would be 10%. Then we double that. So in the case of a 4-year asset, we will double 25%, make it 50%. And then we compute the depreciation by multiplying that percentage by the beginning book value for the period. And I don't take into account the residual value until the very end. So the way that looks is I take 24,000, multiply it by 50%, and that gives me $12,000 in depreciation that first year. So the second year, my book value is now 12,000. I take 50%. That gives me depreciation of 6,000. Next year, my book value is 6,000 times 50%. Now here, we got to be careful. We don't want to depreciate at $3,000 because that would take us below book value. So we adjust that last year to just be 2,000, and then we don't depreciate it further. We don't want to take it down below that $4,000 residual value. So this is what this would look like. You can see the depreciation expense is greater in the first couple of years and it tails off quickly. And the same thing with our accumulated depreciation. We take quite a bit in the beginning and then it increases at a slower rate as we go forward. The next method is my favorite method. I admit I'm enough of an accounting geek that I have a favorite method for depreciation, and that's unit of production. The reason I like this so much is it's really perfect matching. So in the case of units of production, instead of the denominator being a period of time, it's a unit of output. So it might be miles that we drive, it might be hours a machine is used, it might be parts that it produces. If you buy a brand new forklift, the sales person that sells it to you will tell you how many hours it should run with proper maintenance. So you can easily get that kind of a denominator there. So the way we do it is we're going to take, again, the top is the same, cost minus residual values. So in this case, 24,000 minus 4,000. And we believe this vehicle is going to run for 100,000 miles. We're going to use it for 100,000 miles. So we divide by that and we come up with a cost per mile. Then we have to check the odometer every period, probably every year, and then record our depreciation based on how many miles we actually drove in that year, being careful not to go up over that $100,000 mark. So we don't want to record excess depreciation. The thing I like about this, again, is if you can imagine you own that Sprinter van, maybe the first year you use it a lot. The second year, maybe you decide to take some extra classes and go to summer school and you don't use the van at all. Well, the second year you wouldn't record any depreciation at all. So that's really perfect matching. You have no revenue, no depreciation expense. If the third year you start using it again, you start depreciating again. So That's why I like this method so much. I think it's not used in the real world much because people have to get up from behind their desk and go look at an odometer, and they're too lazy. That's just my opinion. So here's how this would look. Based on, again, the number of miles, we would have different levels of depreciation in different years. So it looks like they drove maybe 40,000 miles that first year and 20,000 the second year and so forth. So that's where those numbers come from. And then you can see the accumulated depreciation increases each year as we record depreciation. So hopefully that made sense to you. I will talk to you again in part 2 of this lecture. Thank you.